Good afternoon, everybody. My name is Anthony Njoroge, and I am Principal and Co-Head Africa at Responsibilities Investments. Responsibility is the portfolio manager for the Swiss Investment Fund for emerging markets, and CFM is the development finance institution for the Swiss Confederation. At CFM, what we try to do is to promote inclusive and sustainable growth when it comes to local capital markets across Africa, South Asia, Southeast Asia, Latin America, and Eastern Europe. And I'm quite excited in terms of the work that we do when it comes to that. One of the reasons why I think I exist is to talk about and to invest into the exciting growth opportunities that are present in the African continent. And that's why I'm quite excited to be here with this extraordinary panel of people who are some of the largest allocators of capital, as well as thought leadership when it comes to the intermediated credit space in Africa. In the interest of time, I'll let each of them introduce themselves, and then we can get started in terms of the discussion we're going to have. Maybe Mujahid, you can kick it off.
Thanks. Can you hear me?
Yes, perfectly.
So I'm Mujahid Hassan. I co-lead a capability within our mutual alternative investments called Hybrid Capital. They're essentially the MES strategy for the alternative business of our mutual. The strategy was conceptualized back in 2007. We've done 33 transactions to date with 20 exits across kind of numerous different sectors. Thank you.
Listen.
Hi there, I'm Lisa Rimlin, one of the founding partners of Petula Growth. Petula Growth is a $150 million mezzanine fund, which aims to provide transformational capital for growth to businesses throughout the continent.
My name is Edmund Higenbottam, and I'm responsible for the Verdant Capital Hybrid Fund, which is a $100 million fund investing in digital finance and alternative credit on a Pan-African basis, and we invest a range of mezzanine capital instruments.
Awesome.
Thank you. My name is Tosin Ojo. I'm a partner at Sae Capital. We're an agribusiness private investment firm. We've raised $90 million investing across two strategies, private equity and private debt, focusing on 13 sub-Saharan African countries. Happy to be here on the panel. Thank you.
Great, thank you so much. So if I may start with you, Mujahid, what would you say are some of the factors that are driving the growth of private debt on the continent, especially in light of the current economic system that we face?
Thanks, Anthony. So private debt probably started coming in its own post the global financial crisis, but more recently with rising interest rates and economic growth being uncertain, companies started finding it very difficult to access traditional forms of credit. Therefore, these companies with kind of complex capital structures and limited access to lending markets then started looking towards private debt for a solution to their funding needs. What private debt could then essentially offer them was a solution for a structured product that actually met their specific borrowing needs. And if done correctly, it benefited both the borrower and the lender. From a lending perspective, you're able to achieve better risk-adjusted returns by structuring a product that is able to kind of maximize returns, but at the same time minimizes risks by introducing things like structured or tailored covenants, rate floors, and downside protection. From a borrowing perspective, what they obtained was a kind of structured and tailored solution, customized solution that actually met their specific needs, which then allowed them to kind of implement this strategy with the required funding they raised from that market. On the other hand, though, from an investor standpoint, what it enabled for them is they were able to further diversify their portfolios, and more importantly, were able to kind of extract liquidity from this asset class, which was lacking in other asset classes. even though private debt is attractive, it's not for everyone and does come with risk. So it's actually very important that you appoint an experienced fund manager that's able to kind of structure these products and actually able to understand the risks that come with it.
Mujahid, if I may very quickly just try and follow up on that question. If you look at the private capital space in Africa and the amount of capital that has gone into funds, of the roughly 32 billion that has been raised since 2010, only around 9%, 3 billion has gone into private credit.
Yeah.
What do you think in terms of the appetite from the investor side for such funds, and then B, the number of bankable deals that are there?
I think investors are starting to have more appetite in this space, but I think the problem that exists on the continent is not a lot of experienced managers that's been able to kind of execute on those strategies. And I think that's the difficult part in terms of what we experience with the market and our discussions with them. In terms of bankable deals, though, it's very tricky. So we were traditionally born out of a normal private debt business, and we kind of morphed into mezzanine debt or hybrid capital, which basically operates anywhere between senior debt and equity. So the way we think through things is first to ensure that actually we protect capital, then kind of building up on that hurdle return, and then kind of generating that upside return. Therefore, across our time in terms of managing the strategy, we never lost a cent on any deal, and we at least generated a hurdle return on every single investment. Therefore, the amount of deals we look through, kind of that we throw in our panel, we only execute on about, call it 3 to 5 max a year, which is a hit rate of about kind of 5 to 10%. So it is quite low in terms of bankable deals, but if there is more risk appetite, you could probably execute on more.
Great. Maybe Lisa, jumping to you. Betela specifically targets Africa's missing middle in terms of the type and nature of the businesses that you're going to target. And these are primarily denoted by being largely underserved by traditional lending sources. What are the needs apart from growth capital do you see such businesses having, and what would Betela be able to do to help that?
Thank you. I think often these businesses that require transformational growth don't necessarily have the existing relationships with financiers that will get them to their destination model. So in addition to providing the capital that they require and structuring that for them at the front end, I think what we spend a lot of time doing and talking to investees about is about how they need to develop relationships, what liquidity pools they need to start thinking about today that they would need to be able to access 5 years from now when they are effectively moving into a deeper part, hopefully the deepest part of the capital market. So that, and this, we see this as absolutely critical to supporting the missing middle, because if that doesn't happen, they stall at a certain point. So a lot of attention is placed on that. And it's also, I think for many management teams, these are incredibly well-run, cash-generative businesses with great strategies. But often the language that they may speak is not a language that necessarily translates well for a traditional banker who is able to support a regional strategy. Yeah. So I think it's very much about that collaborative approach to help them to be able to sell and explain their business in a way that allows more traditional lender groups to really understand it, get comfortable with their risk profiles, and continue to grow when we effectively pass them on to the deepest part of the capital market.
Yeah, and maybe very quickly, have you seen Basel IV and the rise of more stringent lending creating more business for you guys?
Absolutely. I think, the regulatory environment does mean that in many circumstances, a decision may not necessarily be purely risk-based when you have to consider the capital that needs to be allocated to transactions. So we do find that we spend significant time working with businesses that are very cash generative, but may not necessarily be able to meet the minimum tangible asset collateral requirements that are stipulated under fairly stringent underwriting standards. So the ability to have a pool of capital, and private credit is still relatively nascent, but the growth of this is absolutely critical to support all sectors of the real economy, to allow them to grow and to be able to sit alongside the more traditional, maybe slightly more restrictive bank debt, and allow equity returns to meet the hurdles that are required there as well.
Great. Edmund, looking at you, there was a conversation we were having on what at first came as a sort of rigid dichotomy, but I just wanted to continue it, with you over here. And if you picture a barbell, on one side you have sector specialized and geographically diversified investments. And then on the other side you have country specialized but sector agnostic opportunities. And I just wanted to kind of explore further your thoughts on that dichotomy and how you see it when it comes to Verdant.
So thank you very much, Anthony. I think, as you alluded to, we are sector specialized at Verdant Capital Hybrid Fund. And that gives us an opportunity to really dig down subsector by subsector, become the expert subsector by subsector, choose which subsectors we want to invest in on a Pan-African basis, and really make a very, very informed choice which business within each subsector, if any, we want to invest in. And if we invest in a business which is, for example, providing financing for young people to get a livelihood, driving border bikes in one country as taxi drivers, that's a good commercial investment, a high impact investment. We can actually make a similar investment in another part of the continent, and there's actually very little risk correlation between those two investments. Equally, so we get that diversification by country, which to me is a very significant risk in Africa, as a risk around individual countries. The converse of that, which is for me country specialized sector agnostic funds, I think in some ways that can be very challenging. These funds in the private credit space are not as large as the private equity funds, not as large as the big private equity funds. And it's very hard, even if you've got a 200, 150, $250 million fund, it's very hard to have that degree of expertise on every single industry sector in order to make really informed investments, subsector by subsector or sector by sector. And actually, being diversified in a single country does give you some risk diversification, but actually when we have problems in an individual country, for example, in Zambia, when we had economic difficulties during the Lungi administration, then actually all sectors in that economy are impacted in the same way or in very similar ways. So there's not really much risk mitigation to my mind in terms of being sector diversified in a single country. And countries like Zambia was very much the poster child of good governance and good business-friendly government, and turned on its head very, very quickly. So we don't actually know what the next country in Africa to have a sort of sharp reverse in economic fortunes, or sharp reverse in the fortunes of their political economy. It could be here. It could be any one of many countries.
And if I maybe piggyback off of that, if I strip away risk mitigation, and I do a performance attribution, and I try to see whether there's any uplift in performance or any enhancement of liquidity, how do you see the two approaches based on performance and liquidity?
I think it gives us an opportunity to pick the highest yielding assets as per our risk framework.
Yeah.
And we wouldn't have that opportunity if we weren't absolutely expert in the sectors and the subsectors we invest in.
Yeah.
And we wouldn't be able to do that if we were restricted to one or two countries.
Yeah, great. Thyssen, maybe turning over to you. A lot of managers talk a lot about the ability to crystallize and execute downside risk mitigations. And I'm just curious about your thinking around that, especially when it comes to the jurisdictional challenges that we sometimes find in the geographies that we invest into. What's your experience and your thoughts on that?
Yeah, thank you very much, Anthony. I think I mean, if we're looking at private credit as an asset class or instrument, in itself and by definition, it kind of helps to mitigate that downside risk. Because when you're structuring when it's private credit or you're structuring for debt, your focus is on minimizing downside loss or risk, and then of course you're foregoing some upside because of that. And because of that, you put in a lot of things. Apart from establishing the credibility of the counterparty, you make sure that at least you have some collateral depending on whatever that is going to be, so that in the worst case scenario, you're able to recover. But for that, you give up a little bit of upside because you're focusing on cash flows and the ability for them to pay you back. So as an instrument or as an asset class, depending on how you want to define it, it in itself gives you the ability to structure for downside protection. Now, the real question is between private credit and equity, or between debt and equity, how far can you go in between, right? So you can, on the closer to the equity side, maybe you can use some convertible instruments that still help you to have that downside protection, right? And at the same time, you can partake in the upside. And closer to the plain vanilla debt side, you then forego the upside and focus on just minimizing your downside. Now, for us at Saye Capital, we've done both, and we're doing both. And one of the things that we're really sort of happy about is, for us, we started as a private equity firm, and our first strategy was private equity sector specialists investing in agribusinesses in Nigeria. But then strategically, we saw an opportunity in private credit. And there's been a little bit of interest, if I may say, in private credit, say in the last 12 months or 18 months. Because when the exit data came out for Africa last year, it was really bad, for private equity funds generally. And that way, we began to see a lot of interest in private debt because they're self-liquidating instruments. But for us, when we became the fund managers for CEFA, which is the Social Enterprise Fund for Agriculture in Africa, a private debt fund, in 2021, 2022, it was more strategic for us because we saw that we could that there are opportunities that are best suited to private debt across the agribusiness value chain, and there are opportunities that are better suited to equity. So even though we're sector specialists in the same sector, there are opportunities that are best for credit or debt, and there are opportunities that are best for equity. And if I may use an example quickly, in the last 15 months, we've done about 10 deals under our private credit fund. And they've been mostly loans, trade finance loans, FX risk mitigated, export-oriented companies. We've done all of that. And maybe a few long-term loans. But the reality is that you cannot deploy equity to that sort of funding and vice versa. So there's need for both asset classes, but depending on how you're structuring and what your focus is as a fund, whether you want to give up some upside or whether you focus on downside protection, then it kind of dictates where you tend to skew, on that framework from like debt to equity.
Great. Maybe Mujahid, if I kind of turn the page and look into portfolio management and the level of operational intensity that credit fund managers bring, what's the level of interaction and the voice that you have when it comes to managing these portfolio companies, especially when compared to other alternative investment strategies like private equity, where you see a lot of hands-on operational involvement?
Yeah, thanks, Anthony. So we, as I mentioned earlier, we operate between senior debt and equity. So we're higher up on the risk curve than your traditional senior debt funding, which means we actually have to be quite close to our portfolio companies in order to kind of manage the risk appropriately. And we do that in a number of ways. One is obviously being kind of close to the operations and the performance of the company, kind of having regular management meetings, monthly management accounts, your kind of financial statements, board backs, etc., the usual. Then also what we also do is we input and we approve in key decision making of our underlying portfolio company. So when there's a purchase of a kind of material asset or a sale of a disposal of an asset as well, starting a new line of business, approving budgets, etc., we get involved in those decision making. So we're actually quite close to the company from that perspective. Then the third thing we also do is we actually take on an observer seat on the board. And we do that so that we can actually be close to kind of the points I mentioned earlier in terms of operations and performance, but also kind of to make quick decisions with the company so it doesn't kind of delay the impact. But importantly, we are still wearing a debt hat. So we want to make those decisions what in the best interest of our debt holders, and if we don't take on kind of full board seats from that perspective, just to kind of manage conflicts appropriately. So in conclusion, we are actively managing our portfolio companies, maybe to not the same extent as our private equity counterparts, but we obviously do that so we can make the right calls from a debt perspective.
Yeah, thank you. Similar to what I've done with Edmund, Lisa, I want to pull a conversation we're having into the public context, and that's on the complementarity that private debt can have with equity investments, and how you see that playing, and again, the role that Betula can bring into that dynamic.
Thank you.
Yeah.
I think the great advantage that private credit can bring to, and the reason it can be so synergistic with private equity is that unlike traditional bank debt, which is quite, needs to fit into particular boxes, private credit can be very flexible to be able to sit alongside private equity and effectively build structures where they are cash flow driven. It's not necessarily a requirement to have collateral to mitigate a risk-weighted asset consideration that you have in a banking group. And I think, at the end of the day, with an appropriate amount of private credit in a structure, you can actually drive a better IRR for your private equity investments because you have a properly stacked capital structure. And so it fits a very important part of the overall capital structure, allowing businesses to continue to leverage their bank debt where it's available, to hopefully grow that pool of bank debt as they are educated about the business and the risks there, but also to allow the private equity firms who've invested in there to generate a good IRR. And I think also one thing which is really helpful is that private credit professionals and private equity professionals speak a common language often, which can make things like, for example, change of control provisions, which are often hugely problematic for banks, something that you can have a conversation around so you can drive an exit for PE, but continue to support and sustain a business that may not necessarily be able to do with less leverage at that point in time.
Great.
Yeah.
Edmund, real quick, Verdant has done, I think, transactions in approximately 30 African countries since 2013, and I'm interested in the gleanings, the lessons, the experiences that you've been able to garner from that, and how it speaks into your current investments in the current hybrid fund.
So we have experience, we have relationships, and we've got a market reputation in 30 African countries. And that doesn't just support origination and deal flow and seeing the best opportunities market by market, but it also enables us to mitigate risk. It enables us to work with the best partners and service providers and mitigate risk from, for example, legal or from a currency perspective. But it also helps us identify markets which we consider to be high risk from a macroeconomic perspective. And it enables us to consider markets where there's significant negative leading indicators from a macro point of view. And we have our own proprietary risk framework. And for these high risk countries, we need very, very significant cross-border risk mitigations in the form of guarantees or otherwise, or we avoid those high risk markets. But it also enables us to choose the markets where we're the most additional, and it enables us to choose the markets which offer the best returns on a risk-adjusted basis. And there's a lot of distortions in Africa. Some markets, for example, have exchange controls, and in many ways the credit return, for example, in South Africa, where there's exchange controls, is actually lower on a risk-adjusted basis than in many other markets in Africa. And having that experience across the board and having that flexibility in our mandate does enable us to sort of arbitrage some of these distortions, as well as maximize our additionality as per our impact and developmental mandate.
Great. Torsten, one of the greatest challenges we have on the continent is lack of funding. And especially, again, once you consider that when it comes to the traditional sources of capital, it's really hard for small and medium companies to have access to that, even when they are high growth. And just very quickly, because I also want to turn the chapter into a new set of questioning, how do you see as the best approach for fund managers to structure their vehicles to address that market failure? It's not just a gap, it's a market failure. What's the best approach for that?
So I think you're right. Traditional finance sources and the banks, they're set up to provide funding in a particular way, like plain vanilla, very particular way. And when you have and because of that, they're probably better suited to provide funding to mature companies.
Yeah.
Now, but then in Africa, you have a lot of SMEs, growing companies. Sometimes they have cash flow cycles that are a bit not plain vanilla, if I could use that word. So I think the first thing is you kind of, as a fund manager, if you want to serve that market, you kind of need to understand the cash flow cycles, because you're not going to be able to do, if you're trying to structure credit, is fundamentally tied to cash flows. And if you're going to do exactly the same thing that the traditional banks are doing, then you have absolutely no additionality, in that sense. Now, that's on a broad basis. What we have found is that it's quite difficult to do, more than it's said, and there are peculiar nuances across different sectors. Now, we are agribusiness specialists, and even within agribusiness, there are different value chains, different crop value chains, and that gives different cash flow cycles, right? And when we structure for our debt fund, we structure around the cash flow cycles for these different value chains, and then we use liquid collateral like receivables and inventory and things like that traditional banks will not do. So if we truly want to serve that market, and of course we've said missing middle, and they find it difficult to get credit from banks, and some of them sometimes they even need some help around advisory, to put their books in order, because a lot of times you can't make sense, that much of their financial account, and so it's difficult, it's hard to do, it's not large ticket, but if you're a fund manager and you want to serve that market, you kind of need to understand. It's probably easier if you try to approach sector by sector than try to do broad base, because, like I said, the nuances across different sectors are very different. And you need that level of knowledge and granularity to be able to structure properly around cash flows, in addition to any other thing you want to put for risk mitigation.
Great. So I, in the remaining time, I want to change the cadence of the discussion, and we're going to shift into more of a speed dating approach. I'm going to ask the same question, and if I can get very quick, very pithy responses, I think that'll be great. And the two questions that come to mind, the first is how private debt returns have been comparing with private equity, especially over the first 5 years. And if I could get quick responses, and then we can go to the second, and then we can see if there are any other questions from the forum. So,
Sure. Yeah.
Jahed?
It's a loaded question. Eh?
Yes.
Sure. Over the last five years, or even maybe even 10 years, I think it's actually outperformed. And generally, what we see is, at least from a mezzanine finance perspective, that product outperforms private equity in low growth scenarios. If you see kind of a higher growth environment, call it 4-5+%, I'm obviously generalizing, then private equity would have kind of a higher return profile than your typical private debt product. But that being said, I'm going to agree with Lisa's point earlier in that it should be working together rather than actually competing, because you can both kind of achieve the right outcome, both for private equity and for ultimate target company.
Lisa, Edmund.
They're great for people to have in their portfolio. They're complementary. I think private credit is generally not as volatile. So, as you mentioned, in high growth, you're probably going to do better on PE. But I do also think that the development of private credit can actually help to drive better returns in PE as well. because of a lack of,
Yeah.
of credit available to PE firms.
And maybe in the last 2 minutes, if I can change gears again and looking at you, Edmund and Tusen, how do you see about the attractiveness of the African market when it comes to private credit, private debt, especially considering the high interest rates that we've been seeing in developed markets?
I mean, strangely, it's actually quite attractive because
Yeah.
from the entrepreneur's point of view, equity is usually, they are usually more cautious towards an equity conversation. It's long, it takes very long before they get comfortable around an equity conversation. You know, and we're talking about SMEs, right? So it's actually quite attractive. Now, obviously, depending on the business and the interest rate level, you know, because some businesses have the headroom, you know, because of their maybe margins and cash flows to accommodate high interest rates, and some less so. But we find that debt conversations are faster. And when I said it was strategic for us, you know, as a private equity firm, it's a way for us to start building relationship because they are quicker, they are faster. We can assess the credibility of the counterparty on a less risky instrument, and then know whether, you know, this is worth considering, you know, larger tickets and for our equity fund. So really strategic for us. It's actually quite interesting and for a lot of entrepreneurs. The problem though is that many of them actually need equity and not debt. So while it's an easier conversation to have debt and it's a faster conversation, you know, as an expert, a lot of times their cap table is quite messed up. They really actually need equity and not debt.
Edmund?
So right now in the US high yield is trading at around treasuries plus 4%. The lowest risk part of our portfolio, junior debt with credit enhancement, we typically price as SOFR plus 12, and actually we've been achieving higher rates than that. And SOFR is higher than US treasuries.
Yeah.
And the companies, yes, we've got more country risk, we've got more macro risk in our part of the world in Africa. But if you look at the cap tables and the cap structures and the cyclicalities of the business in the US high yield peer group, we wouldn't consider them bankable in Africa. We would consider them as being distressed or being workout situations. So private equity is not performed in Africa versus the US. But I think as the world stands today, private credit offers a very interesting relative value proposition versus US high yield and other US asset classes. And it's not correlated. And I think it commercially, as well as impact and developmental opportunities, it adds a very interesting piece in your portfolio if you are a global or US focused investor.
Great. Well, I had promised Abby I'd keep time, and I like to keep my promises. So I think we've come to the end of the session. I can see something flashing there, kind of telling us to run off stage. So thank you, everyone, for participating in our discussion. Thank you to the panel. Again, really appreciate it. Thank you.
Thank you.
Thank you.